Hello everyone, welcome to Infinite Floating Stocks. I am Venkat, and in this session I'm going to explain you an amazing strategy. Okay, so the name of the strategy is short strangle option strategy. Okay, I repeat, the name of the strategy that we are going to discuss in this session is short strangle option strategy. Okay, so let's not waste the time. Let's start. Okay, so contents here are the contents for today's session. I'm going to discuss about what is short triangle option strategy, and also I'll be helping you. I'll be telling out some important things that you need to be considering before choosing the strikes. Okay, so I'll be explaining you which strikes to choose, and also we'll be discussing about what's the risk involved and what will be the maximum reward that you can get if you use this strategy. And also I'll be telling out the break even point, which is no profit no loss scenario. So I'll be explaining you about break even points as well. And important, yeah, payoff chart. You need to have good command on payoff chart. Okay, so I'll be explaining you the role of payoff chart for short triangle. Okay, when you take some position, you need to be looking at payoff chart in Opstra strategy builder. Okay, so I'll be helping you out. I mean, I'll be telling you how to use it and how to look at it when you are in a trade. And yes, we'll be discussing about effect of volatility and also effect of theta on short triangle. I mean, I'll be telling you when to implement the strategy and why to implement, what should be the entry point, what should be the stop loss, what should be the target. Okay, I'm going to discuss everything in detail in this session. Okay, so this session is very important and this strategy is very powerful. Okay, this strategy is very important and this strategy gives good returns. Okay, so you can generate monthly income from this strategy. Okay, in our previous session I have told you that if done properly, if option selling done properly, one can earn monthly income from selling options, right? So I'm going to tell you how one can make consistent monthly income from option selling. Okay, so you can use this strategy to do that, to generate consistent income from stock markets. Okay, so this is very simple strategy. So I'll be explaining everything in detail so that you gain confidence and gain money from the market as well. Okay, so and yeah, I'll be telling these are other contents that we're gonna discuss in the session in next few minutes. I'll also tell you about what should be the entry point, what should be the entry time, and when you need to exit, and also what should be the stop loss when you are trading on Monday or Tuesday or Wednesday or Thursday. Okay, stop loss varies from day to day. So if you are using short triangle on Monday, stop loss is different. If you are using short triangle strategy on Tuesday, stop loss is different. So it varies from day to day. So I'm going to tell you what should be the exact or nearest stop loss that you can put when you are trading using short triangle in on Monday, Tuesday, and Wednesday, Thursday. Okay, I'll be telling you out that. Okay, I'll be telling you that, and finally, I'll be ending the session with a few important points that you need to be keeping in the mind when you are dealing with this amazing strategy. Okay, all right, let's look at the first content, which is short triangle option strategy. What is short triangle option strategy? Okay, it's pretty simple. Let's have a look at formal definition. Let's have a look at definition of the strategy. Then I'll be explaining you in very simple words so that it directly gets into your head and you rock in the market. Okay, so all right, this is a definition for short triangle option strategy. So the short triangle is also known as sell triangle. Simple, there is nothing, don't make it complicated. Okay, so it's very simple. The short triangle is also known as sell triangle. You already know shorting is nothing but selling first and buying later. Okay, so long is nothing but buy first and sell later. Okay, so the short triangle is also known as sell triangle. Okay, is a neutral strategy. Okay, when I say neutral strategy, that means you this strategy has a capability of making money irrespective of market direction. You will get profits even if it is moving towards upward. You will get profit even the market is moving towards downward. You will be also in profits if market is moving sideways. Okay, amazing, amazing, right? I know most of the students are really excited and really wanted to know the reason why this strategy is giving money irrespective of market movement. Okay, yes, you have read it right. Yes, you have. I mean, I'm speaking the truth. I have implemented this strategy and I have been implementing this strategy since lot many days and years, and I have been making good money. So I'm speaking with that experience. So yes, it is possible to make money using this strategy irrespective of market direction. Okay. There is a possibility of making money even if market is moving towards upward, even if the market is moving towards downward, and even if the market is moving towards sideways. Okay. So what can market do? Either it can move up, or it can move down, or it can move in a sideway, right? So with this strategy, one can make money irrespective of market direction. Even if the market is bullish, even if the market is bearish, even if the market is moving in a sideway, this strategy will make you money. This strategy will help you to book profits. This strategy will help you to gain money from the market irrespective of market direction. Okay. So pay utmost attention to this session. You will be amazed by the end of the session. I guarantee you. Okay. All right. So the short triangle is also known as cell triangle. Okay, leave about it. There is nothing in line number 1. So the short triangle is also known as cell triangle, is a neutral strategy. Okay, neutral strategy is nothing but irrespective of market direction, you gain profit, you gain money. So the strategy is called neutral strategy, or cell triangle, or short triangle strategy. Okay. So it is an okay. In this strategy, the option trader that the option trading that involves simultaneous selling of slightly out of the money, slightly out of the money put, and slightly out of the money call. Okay, what you are doing? You need to sell here, selling, which is nothing but you are an option seller here. Okay, so you need to sell slightly out of the money put option and slightly out of the money call option, okay, of the same underlying index or stock, and same expiration date. Okay, I repeat, the definition is very simple. The short triangle or sell triangle is a neutral strategy because irrespective of market movement, you make money. You can make money if you use this strategy properly. Okay, so this is called neutral strategy. So in this strategy, uh, it, it involves the simultaneous selling. Simultaneous in the sense you need to do it immediately. Okay, you need to do it immediately. So simultaneous selling of slightly out of the money put option and slightly out of the money call option. You need to sell two things. One thing is out of the money put option, and other thing is out of the money call option. Okay, simple. If you sell out of the money put option, if you sell out of the money call option, then that strategy is called short triangle option strategy. Okay, so you need to be selling out of the money, slightly out of the money call option, and also slightly out of the money put option of same underlying asset and of same expiry date. Okay, now let's get on to option chain and look for what is slightly out of the money call and slightly out of the money put. Okay, so option chain. All right, this is option chain table. Now what is slightly out of the money call option and slightly out of the money put option? You already know what is in the money, out of the money, at the money. Okay, so if the data is in yellow area, then it is called in the money data. Okay, if the data is in white area, then it is called out of the money. uh, okay, out of the money data. Okay, so if the data is present towards left side of the table and present in yellow area, then it is called in the money call option data. Okay, and these strikes are called in the money call strikes. Okay, so if the data is present in white area towards left side of the table, then it is out of the money calls. Okay, then I mean that data is related to out of the money calls. So this is out of the money put data present in white area, and if the data is towards right side of the table, then it is out of the money puts. And if the data is present in yellow area and towards right side of the table, then it is called in the money I mean that data is related to in the money put, in the money puts. Okay. Now see, what is at the money? At the money is simple. I mean, the point at where the color change happens, those two strikes are called at the money strikes. Here 14,350 and 14,400 are at the money strikes. Okay. So now tell me, according to short triangle, what we need to do? We need to sell out of the money call option and out of the money put option. Okay. So out of the money, in the sense, you need to be selecting the strikes which are present in white area. Okay. So this is white area. You need to be selecting one strike from this area and you need to select other strike from this area. Okay. I repeat, the short triangle option strategy is nothing but you need to be selling out of the money call option and out of the money put option at the same time. Okay. For that, out of the money is nothing but data which is present in white area. Okay. So you need to be selecting one strike price from this white area and you need to be selecting another strike price from this white area. Okay. So this white area strike price is called put strike, out of the money put strike. And if the strike price is chosen from this white area, then it is called out of the money call strike. Okay. All right. Now see, what I told, you need to be selecting or selling slightly out of the money call option and slightly out of the money put option. Okay. So now see, uh, this is ATM. This is ATM strike price. This is also ATM strike price. So 14,300, 14,250, 14,200 and 14,150. All these are slightly out of the money put strikes. Okay. So because it is in white area. Now see, I'll talk about calls now. 14,400 is at the money. Okay. Because here the color change happened. And 14,450, 14,500, 14,550 and 14,600. All these four strikes or five strikes, 14,650. All these four or five strikes after out at the money are called out of the money call strikes. Okay. So 14,450 or 500 or 550 or 600 are called out of the money call strikes, and 14,300, 14,250, 14,200 and 14,150 and 14,100 are called slightly out of the money put options. Okay. Slightly out of the money put strikes. Okay. So you need to be selecting or you need to be selling one strike from this part and one strike from this part, which are to be out of the money towards call side, and one has to be from out of the money put side. Okay. All right. Now, okay, we are done with definition. It's very simple. If you select or if you sell out of the money call option and out of the money put option at the same time, then it is called short triangle option strategy. Okay. Now see, we can implement short triangle if we are unclear about the market direction. That's what I told, right? Neutral strategy. It is neutral strategy or non-directional option strategy, because irrespective of market movement, you will get the profits. Even if the market goes upward, even if the market goes downward, even if the market moves sideways, irrespective. So irrespective of market direction, you will be in profits. Okay. Now, okay, implement this strategy if you are unclear whether the market goes up or goes down or sideways. Okay. So we can implement this short triangle if we are unclear about the market direction. That means it can go either upward or it can go either downward or it can move in a sideways direction. Okay. Irrespective of market direction, irrespective of market movement, we can make money with this strategy. Okay. Just get that thing into your head. Okay. Irrespective of market direction, we'll be able to generate profits using this strategy. So this strategy is called neutral strategy, or this strategy is also called as non-directional option strategy. Okay. Because irrespective of market direction, we'll be in profits. So that is the reason this strategy, the short triangle strategy, can also be called as non-directional option strategy. Okay. Now let's get on to the next slide. I'm hoping that you guys are pretty clear with the definition and what has to be done when you're dealing with short triangle. It's very simple. It's very simple. You just need to sell slightly out of the money put and slightly out of the money call. Okay, that's it. Now I'll be telling you when to do that, at what time you need to do that, when to exit, at what time you need to exit, and which strike to choose among 4 to 5 slightly out of the money strikes. Okay, I'll be telling all of those things. I'll be explaining all those things in detail in next few minutes. Okay, stay excited. All right, which strikes to choose? Pretty simple. So you already know what's we are dealing with short triangle. Okay, that means we need to be selling one out of the money call with one out of the money put. Okay, so just get that thing into your head. Short triangle is nothing but you need to be selling one out of the money call option and also one out of the money put option. Okay, and okay, selected OTM strikes should have high OI and high change in OI. Okay, let's get on to the option chain table. Then I'll be telling you which strike is having a high OI and which strike is having high change in OI. Okay, you need to be considering these three things when you're choosing strikes. Okay, all right, here is trading platform and this is option chain table. Okay. What is out of the money? It's pretty simple data which is present in white area. Okay. Now see, I'm dealing with out of the money put. Okay. Now I'm going to select a strike price from out of the money. Okay. Now where is OI? This is OI and this is change in OI. Okay. These two columns. You need to be looking at these two columns while selecting out of the money put strike. Okay. So this is OI and this is change in OI. OI is nothing but open interest. I hope you guys remember this. I already explained about OI, change in OI, and lot many things in our previous sessions. Okay. Now see, what did I write there? The selected OTM strikes should have high OI and high change in OI. You need to be having high OI and high change in OI. That means the numbers should be huge. Now see, here OI is only 4,000. Here it is 19,000. Here is 4. Here it is 4,000. But here it is 25,000. Okay. So this is high, right? This is high. So you need to be selecting this strike, which is 14,200 put strike. I repeat, while selecting slightly out of the money put strikes, you need to be considering high OI and high change in OI strikes. Okay. For that, you need to be looking at high values in OI and change in OI columns. Okay. Now here, if you look at this strike price, if you look at this OI of 14,350 strike, it's only 4,000. Okay. Here it's just 19,000. Here it is 4,000. Again, very less. Again, this is 25,000, which is huge among the slightly OTM strikes. Okay. So this is 16,000, which is also less than 25. Okay. So 25,000 is the highest OI in slightly OTM put strikes. Okay. So I need to be selecting 14,200 put strike. Okay. And coming to out of the money strikes of call option. Now look at high OI. Here it is 20,000. Here it is 6,000. Here it is 44,000, which is huge. Here it is 14,000 again. Again, look at this thing. Here it is 50,000, which is very huge again. So which is huge in slightly OTM. 50,000 is high, right? 50,000 is highest value. 50,000 is highest value in OI. Okay. And look at change in OI. Change in OI, here it is 26, here it is 25. Only 1,000 difference, no problem. So you can consider this thing. Look at this thing. Compare 14,500 strike with 14,600 strike. Here the OI is highest for this thing and change in OI is differing by only 1,000. So not a problem. Okay. So you need to be selecting this 50,000. You need to be selecting 14,600 OTM strike for call option. Okay. So that's how you need to be deciding which strikes you need to be choosing, and you need to be choosing that you need to be selling or you need to be shorting out of the money that put strike and this call strike. Okay. Which is having high OI or high change in OI. Okay. I hope you guys are getting it. I'll be explaining it again in some time. Okay. So, and also you need to be looking at India VIX. Okay. The volatility should be very less. Okay. When you're dealing with this strategy. When I say India VIX, go to trading platform. Now you should be adding this INDIA VIX, India VIX, which is nothing but volatility index. You need to be adding this to your watch list. Now look at it is 22.42 here. I'm so sorry. India VIX. Okay, India VIX, it's 22.42 here. Okay, the value of India VIX is 22.42. Okay, so this VIX value should be below 24 or 25 if you are dealing with short triangle option strategy. Okay, so that's the second thing. And third thing is premiums should be close to each other. Okay, premiums should be close to each other. Let's look at that thing as well. Let's get on to option chain table and premiums. What was the strike that I have chosen here? This one, right? Which is having 25,000. Okay, which is having 25,000 as OI. So what's the last traded price? This is the premium. 73 rupees is the premium. And here I have selected 14,600, which is having 49 as premium. Okay. So there it is 70, here it is 50. There is 20 difference. So you can select this thing. You can select 14,550 as well. Okay, pretty close, no problem. 60 and 70. So there should be not very close, but they should be little bit closer to each other. Okay, you will find them. I mean, this data will change every time. Okay, in live market, the data will be changing for every 2 minutes or 1 minute. So depending upon that movement, you will get premiums close to each other. Okay, so you will understand it when you are trading, when you're doing live trading. Okay, so now this is very important. So which strike to choose? I hope I have answered all the questions related to what strikes has to be chosen. Okay, the first thing is when you're dealing with short triangle option strategy, you need to be what you need to be doing. You need to be selling one out of the money call option and one out of the money put option. Okay, so there are lot many out of the money put options and there are lot many out of the money call options. Okay, among them you might be having the question which strike to choose among lot many out of the money call options, among lot many out of the put options, out of the money put options. Okay, among them you need to be looking for three main criterias before choosing the strike price. Okay, the first main criteria is you need to be selecting the strike price which is out of the money and which is having high OI and high change in OI. Okay, so here OI is only 4,000. Here it is 19,000. Here it is 4,000, and again here is 25,000. So among all the closest or slightest out of the money strikes, 25,000 is highest OI. Okay, so I should be selecting this strike, this out of the money put strike. And coming to call side, this is OI column, this is change in OI column, and this is the value of OI here is 20,000, this is 6,000, this is 44,000, this is 14,000, and this is 50,000, which is huge among all the slightly out of the money call strikes. Okay, so I should be selecting this 50,000 strike. I mean, I should be selecting this 14,600 strike, which is having 50,000 and 25,000 OI and change in OI. They are huge when compared to all this data. Okay, so that's how you should be selecting the strike. That's the first priority. And second priority is you need to be looking at India VIX in your trading platform. And this India VIX should be less than 25. Now it is 22. Okay, so you can implement this strategy. If you want to implement this strategy, this short triangle strategy, it VIX should be less. That means volatility should be less. Okay, volatility is nothing but it tells that with how much speed the strikes or premiums or market can move. Okay, so for short triangle option strategy, we need less volatile market. Okay, so that means you need to be having I mean India VIX should be less than 24 or 25 to implement this strategy. That's the second condition you need to be following while selecting the strikes and while choosing whether to implement the strategy or not. Okay, and the third main thing is premiums. Okay, premiums should be closer to each other. Okay, coming to premiums, let's get on to option chain table. Here the premium is 73 for the strike which we have chosen, which is 14,200, and here 14,600, which is having 50 premium. You can select either you can short 63.5 premium, which is 14,550 as well. Okay, so they should be closer. They should be not very closer, but they should be little closer to each other. Okay. So these are the three criteria that you need to be following for sure to get good results from this strategy. Okay. So the first thing is you need to be selecting the out of the money put strike or out of the money call strike. Okay. Which is having high OI or high change in OI. Second thing is look at India VIX, which should be less than 24 or 25 to implement this strategy. Okay. And third thing is premiums. Okay. So the strike price which you are planning to sell, the premiums of that strike price should be less. Okay. I mean, should be closer to each other. Okay. Not very closer, but they should be little closer to each other. Okay. All right. So which strike to choose? Okay. Continuation of the previous slide. Now, the short strangle option strategy is okay. It is a limited profit and unlimited risk option trading strategy. Okay. Now, don't get threatened or don't feel sad by seeing this unlimited risk. Okay. So we can convert this unlimited risk to limited risk by putting proper or good stop loss. Okay. I repeat, the short strangle is an option strategy where or which is having limited profit. Okay. We'll be having limited profit and unlimited risk, unlimited loss. Okay. When you're dealing with this strategy, but by putting proper stop loss and by putting good stop loss, we'll be able to control that unlimited risk. Okay. You can convert that unlimited risk to limited risk, or you can convert that unlimited loss to limited loss by putting proper stop loss. Okay. Stop loss is very important when you are dealing with this strategy. Okay. Do not forget to put stop losses. So the short triangle is a limited profit and unlimited risk option trading strategy, and that is taken when the option trader thinks that the underlying stock will experience little volatility in near term. That's what I told, right? India VIX should be less than 24 or 25. Okay, we need less volatile market to get good results using this strategy. Okay, so unlimited risk can be controlled by putting proper stop loss. Okay, now what's the risk and what's the reward? Pretty simple. Before that, let's get on to payoff charts. I'll be explaining you payoff charts so that you get clear idea about risk and reward thing. Okay. So consider or imagine that we are dealing with Nifty, and let me select options here. Let me select the nearest expiry. Then what I need to be doing? I need to be shorting out of the money call option and out of the money put option. Okay. Which is having high OI or high change in OI. And the second thing is we need to be choosing the, I mean, we need to be looking at the VIX, which should be less than 24 or 25. And third thing is premiums should be close to each other. Okay. According to our analysis, what I told, I should be choosing 14,000. This is 25,000. Okay. So I need to be choosing 14,200. 14,200 put. Okay. So let me enter 14,200. 14,200 put, sell, one lot, add position. Okay. And this, what was the strike price that we have chosen to short towards call side? That is 14,600 or 14,550. Okay. Let me select 14,550. 14,550 call, short, one lot, add position. Okay. Now this is how the payoff diagram look like. Okay. Now see, so this is a break-even point. What are break-even points? 14,064 and 14,686 are break-even points, and you will be losing money if market breaks 14,064 or if it breaks 14,686. Okay, so here you will be in profits if market is staying in this range. Okay, let me explain with charts. Let's get on to Nifty. Okay, this is Nifty, and 14,600, 14,600 and 14,200. Okay, so 14,200 put strike and 14,600 call strike that we have shorted, right? So now, okay, irrespective of market direction, you will be in profit if market stays in this range. Okay, so imagine that the next trading day, if market opens here and it comes like this, if it moves upward again like this, and if it falls down like this, sorry, if it falls down like this, then if it moves like this, then again it comes like this. So irrespective of wherever it goes, you will be in profits if it ends in this range. Okay, it should be in that range only. It should be between 14,200 and 14,600 strike. Okay, so this is how the payoff diagram looks like. And looking at the payoff diagram, you can realize that the loss is unlimited when we are dealing with this strategy. Okay, so this can be controlled by putting proper stop loss. I'll be explaining about stop loss rules in next few minutes. Okay, so these are the break even points, which is 14,064 and 14,686. Okay, so these are break even points, and once that point is broken, that means if market is breaking this point, or if the market is breaking this point, you'll face losses. Okay, so you should make sure that market is not breaking this point and this point. Okay, so it should be staying only in that range. If it is staying or if it is ending in that range, then we will be in profits. Okay, so you should make sure that market is not breaking that range and this range. Okay, it should be in that range only to be in profits. Now that is a break-even point, which is 14,064 and 14,686. Okay. All right. This is a payoff diagram, and this is a maximum profit that you can get is 10,238. And this loss can be controlled by putting proper stop loss. Okay. Don't worry about it. So what is the risk and reward? You already know risk is unlimited and reward is limited, but unlimited risk can be converted to limited risk by putting proper stop loss. Okay. Now, all right, risk is unlimited when you're an option seller. What we are doing, we are selling out of the money call option, and we are also selling out of the money put option. Okay, so risk is unlimited here, and risk is unlimited in short triangle option strategy. Okay, you know this by looking at the payoff diagram. Okay, so the maximum loss for short triangle strategy is unlimited. Okay, no worries, we put proper stop loss and we work. Okay, don't worry about it. And large losses for short triangle can be experienced when the underlying stock price makes strong move either upward or downward before expiration. What is a strong move? Strong move is nothing but, yeah, imagine that market, imagine that market opened here and it came like this and it fell like this. Okay, so this is a strong move. Okay, so in this type of moves, if it is breaking our range, then we'll be facing losses. Okay, so we need market to be in that range only. In between, we need market to be staying between 14,200 and 14,600, the strikes which we have sold. Okay, so we need market to be staying in that range only to be in profits. Okay, so we need sideway market or less volatile market for that. Okay, we don't need market to break the boundaries and come out of it. If it is breaking the boundaries and coming out of it, then we'll be facing unlimited losses. Okay, and that can be controlled by stop loss. No, don't worry about it. Okay, so large losses for short triangle can be experienced when the underlying stock, nothing but underlying index or stock, moves strong move either upward or downward before expiration. Okay, you should make sure that the underlying asset, the index, that should be staying in that boundary only. It should not be breaking the boundaries and coming out of it. If it is breaking the boundaries, then you will face unlimited loss. Okay, even though it is breaking, then you can, okay, you can, that will hit your stop loss. No worries. Anyway, you'll be facing only less loss. Okay, because our position will be hedged and you will be in profits only. Sorry, you will be facing very less loss. Okay, So with proper stop loss, this strategy can be a game changer. So I'll be explaining about stop loss in next few minutes. Okay. So here is the formula to calculate the maximum loss. Ignore this bullshit formula. It's really unnecessary. Just have a look at payoff charts. You will understand everything. Okay. If market is coming out of this range, this is a range that I am talking about, which is 14,064 and 14,686. Okay. So market should be staying in that range only for us to be in profits. Okay. If it is breaking that range, then our loss will start. Okay. If market moves strong movement towards downward or towards upward, then we'll be facing losses. Okay. So to control this loss, we use stop loss. Okay. And yeah, this is the range. If it stays in that range, we'll be benefited. We'll be getting the profits. Okay. All right. So ignore this formula. Have a look at a payoff diagram. You'll understand everything. Look at if market is staying at 14,158, look at your profits. It's 7,088. If it is staying at 14,494, your profits will be 10,238. If it stays at 13,997, your loss will be minus 4,988. Or if market moves to 14,733, then your loss will be 3,488. Okay. So payoff diagram gives you everything related to this strategy. So ignore those formulas. Do not write them. So just try to understand payoff chart. Okay. So profits are limited. We already know this from the diagram. See, profits are limited. The maximum profit is only 10,238. Okay. So that's the maximum profit that you can get. So profits are limited when you're an option seller, and profits are limited in short strangle option strategy. Okay. So the maximum profit for short strangle occurs when the underlying stock on an expiration day is trading between the strike prices of sold options. That's what I told. Sorry. See, we'll be getting maximum profit if it is trading between this range. If stock is trading between this range. Okay. If it is staying between this range, so if it is staying in this range, we'll get profits. Okay. So all right. So profits are limited when you're an option seller, and profits are limited in short strangle option strategy. Okay. So the maximum profit for short strangle occurs when the underlying stock price on expiration date is trading between the strike prices of sold options. Okay. It should be staying between 14,200 and 14,600. It should not break that boundaries. If it stays in that boundaries, you'll get the profits. If it is breaking the boundaries, your stop loss will get hit. Okay. Even if it is breaking the boundaries, you will be facing only less loss, because this strategy is hedged strategy. And if I mean, let me get onto the chart. Look at this thing. 14,600, 14,200. This is our range, right? Okay. So imagine that market moved wild. Market was very wild and volatile. And imagine that our upper boundary is broken. Okay. In that scenario, you will be in profits. I mean, you will get profit from this side. You will get profit from put side. Okay. If this lower boundary is broken, then you will get profits from call side. Okay. Because we are selling out of the money call option and also out of the money put option simultaneously. Okay. So if upper boundary is broken, you will get profits from put side. If lower boundary is broken, you will get profits from call side. Okay. So positions are hedged. Even if your stop loss gets hit, you will be losing only less money, very less money. Okay. So because positions are hedged, you will get profits irrespective of market movement. If market is moving wildly, if market is moving impulsively, if market is breaking the boundaries, in that scenario, you will be losing less money. Okay. If upper boundary is breaking, I mean, if market, imagine that market broke upper boundary. In that scenario, you will be seeing profits on put side. Okay, imagine that market has broke lower boundary. In that scenario, you will see profits from call side. Okay, so because positions are hedged here, even if your stop loss hits, even if the market moves impulsively and break boundaries and come outside also, even if your stop loss hits also, you'll be facing only less loss. Okay, so that's the advantage of this strategy. So maximum profit for this is done. We'll get maximum profit if market stays in that boundary, in that range. Okay, so at this price, both the options expire worthless, and option trader gets to keep entire premium taken as profit. Okay, ignore if you don't understand also, no problem. You will get all the information from payoff chart. Okay, all right. So there's a formula for calculating maximum profit. Not necessary to buy heart, and not necessary to write down, or not necessary to give attention to this slide. Okay, just practice payoff chart. You will get to know what's the maximum loss, what's the maximum profit, and what are break-even points and all those things. Okay, so break-even point is nothing but it's a point where you don't get any profit and any loss. Okay, so this is a formula for calculating break-even point. Not necessary, just get on to Opstra, add your positions here. Then look at this break-even points. This is a break-even point. So 14,064 is lower break-even point, and 14,686 is upper break-even point. This is lower boundary, this is upper boundary. Okay, so market should be staying in that range only for us to be in profits. If it is breaking lower range, you will get profits from call side. If it is breaking upper range, you will get profits from put side. Okay, so irrespective, and if your stop loss get hit, then also you'll be losing only less money. Okay, because the positions are hedged here. Okay, hope you guys are understanding it. So this is a formula to calculate break-even points. Not necessary to remember, just use payoff diagram or Opstra strategy builder to get to know about your break-even points. Okay, now payoff chart. You already know this. I already shown you how to add them. Okay, it's pretty simple. I'll reset everything and I will add again for you guys. So I have selected, okay, let's try Bank Nifty. This is Bank Nifty. Okay, this is Bank Nifty, and select options. Let me select strikes, Bank Nifty strikes, Bank Nifty. Now tell me which is having high OI and high change in OI. This is 14,000, 4,000, 27,000, and 3,000, 4,000, 3,000, 4,000. Okay, all these are very less. 27,000 is highest. So I'll select 31,000. 31,000 out of the money put. Okay, 31,000. 31,000 put. Click select sell, add position. Okay, now let's select strike from call side. 9,000, 8,000, 31,000, which is very huge. 9, 10, 12, 12. Okay, so 31,000 is huge. I mean 31,000 is the highest value in OI, so I select 31,500 as strike price. Okay, 31,500 towards call side. 31,500 call side, add position. Okay, so this is how your payoff diagram or payoff chart looks like, and market should be staying between 30,405 and 32,905 for us to be in profits. Okay, so these are the break-even points for that, and this is how the diagram looks like. If market ends at 31,533, you will get 14,000 profit. If market ends at 31,926, you will get 4,249 rupees as your profit. If market ends at 30,760, you will get 8,899 as profit. Okay, if it ends at 30,142, then you'll be losing 6,551 rupees. Okay, so that's how you need to be choosing the strikes and adding them here, and have a look at payoff chart so that you will get how much money you're gonna lose if market is going that at that point, how much money you're gonna gain if market ends at some other point. Okay, and you need to be having a clear view on break-even points. Okay, so these break-even points help you, says you that market should be staying in that range only for you to be in profits. Okay, so this can be calculated very easy. Okay, let's look at the formula. So upper break-even point, what is strike price of short call plus net premium? Pretty simple. Strike price, what is the strike price of short call? 31,500, right? 31,500 plus 280. 31,500 plus 280 will be this thing, and 31,000. Okay, net premium received. I'm so sorry. It should be calculated like this. 31,500 plus this premium 315 plus this premium 280 equal to 32,095. Okay, 32,095. Got it? You need to be adding two premiums for upper boundary. For lower boundary, you need to be selecting 31,000 minus two premiums 315 minus 280. Okay, so 30,405, that is the lower boundary. Okay, so that's how you need to be calculating the break evens. Okay, so if you don't want to calculate, if you don't want to remember the formula, no problem, just have a look at payoff diagram, or just have a look at this website, which is for free, which is accessible for everyone for free. So this tells you the upper limit and lower limit. Okay, so if market stays in this range, you will be in profits. If it is breaking that boundaries, your stop loss will get hit. And even though if your stop loss getting hit, you'll be losing only less money because positions are hedged here. Okay. All right. So that's the formula for break even. And that's how you need to be using payoff charts. Now, effect of volatility. You already know volatility, India VIX should be less than 24 or 25. Okay. Remember that point. So lower the volatility or VIX or IV, less will be the movement in the market. Okay. Volatility is nothing but it tells about the speed with which the market can move. Okay, so lesser the volatility, lesser the VIX, less will be the movement in the market, which benefits shorted call and shorted put positions. Okay, so short strangle needs sideway market. Sideway market in the sense it moves sideways and stays in that range only. It should not break the boundaries. Okay, that is why we need less volatile market and sideway market for us to gain maximum profit from short strangle option strategy. Okay, so short strangle needs market to stay in between shorted strikes. That's what I told. That boundary, remember that boundary? It's 14,600 and 14,200. Okay, not exactly, but it will be little bit higher and little bit lower. Okay, because of that break even formula calculation. Okay, all right, market should be staying in that range only for us to be in profits. If it is breaking upper boundary, no problem, we'll be losing only less money because you will be able to see profits from PE side. Okay, if it is breaking lower boundary, if our stop loss gets hit, even though no problem, we'll be losing only less money because we'll be able to see profits from CE side. Okay, because positions are hedged here. All right, let's talk about effect of theta on short triangle. Okay, so time decay, which is also called as theta decay, oh, that will have positive impact on short triangle. Okay, because theta decay is nothing but time decay, which is nothing but the value of the premiums will come to zero. All out of the money call options and all out of the money put options will expire to zero. Okay, on expiry day. Okay, they won't be having any value after expiry day. Okay, so all out of the money call options and all out of the money put options will come to zero on expiration day, and they won't be having any value after expiration day. Okay, so theta decay plays crucial role. Theta decay or time decay will play the crucial role in bringing premiums down to zero on expiry day. Okay, so that is the reason the theta will be very powerful when it is moving closer to expiry. Okay, I have been telling this since very long, and I have been talking about theta and time decay in each and every session because it's very important. Okay, for an option seller, theta is best friend, and theta will earn you lot many profits when you are an option seller. Okay, so you should be loving theta if you're making money out of option selling. Okay, so theta decay or time decay will have a positive impact because premiums will decrease. That's what we want. Okay, because we are selling options here, we are an option seller here. We sold out of the money call options, and we also sold out of the money put option. We are an option seller here. That means we need premiums to decrease, we need premiums to come down to zero. Okay, uh, that is why we should love theta, because theta is helping us to bring the value of the premium to zero. Okay, so that is why people say theta is a best friend of option seller. Okay, so time decay or theta decay has a positive impact. I'm hoping that you guys understand. Okay, theta decay and time decay has a positive impact on short triangle option strategy when it is closer to expiry. Okay, and decay happens faster when it is closer to expiry. You already know that theta will be more powerful, theta will be more aggressive on Wednesday and Thursday, because Thursday is expiry. Okay, when it is moving close to expiry, decay happens very faster, time decay happens very faster. Okay, you need to remember that point. Short triangle strategy will give you more profits on Wednesday and Thursday when compared to Friday, Monday and Tuesday. Okay, so when to implement this strategy? Now you already know which strikes to choose. You already know how to use payoff diagram. You already know what is the risk involved when you are using short triangle option strategy. You already know what is the maximum profit that you can get when you are dealing with this strategy. Now you need to know when to use this strategy, when to implement this strategy. Okay, so stay excited. It's very important. Now, short triangle can be implemented on every day. Surprised? This strategy works every day. Okay, so you can use this strategy every day, and you can make money every day using this strategy irrespective of market movement. Okay, the only thing that you need to pray for is that market should be staying in your range. Okay, that market should be staying between upper boundary and lower boundary. Okay, that means market should be staying between the upper strike price, the upper out of the money call strike which you are shorted, and it should be staying between the lower strike, the lower put strike which you have, I mean the lower out of the money put strike which you have shorted. Okay, it should be staying between those two strikes, those two out of the money call and put strikes. uh, if it stays, then you'll be benefited, you will get profits. Okay, so short triangle can be implemented on every day. If VIX is less than 23 or 20, if India VIX is less than 24 or 25, that means market will be moving sideways most of the times, and sideways market is beneficial for this strategy. And if market is moving sideways and doing time pass, in that time theta decay will happen. If theta decay is happening, premiums will come down. When premiums are coming down, you will get the money, you will get into profits, because we sold out of the money call option and out of the money put option. Okay, so they all are interrelated. Okay, when VIX is low, market moves sideways. That means market is doing time pass. Okay, market will stay in that range only. If it is wasting time and moving sideways, in that time theta decay happens. If theta decay is happening, that means premiums will come down. Okay, when premiums are coming down, our profits will increase because we are short on, we sold we sold out of the money call option and out of the money put option. Okay. Okay, so implement this strategy when you estimate that market will stay between shorted out of the money call and out of the money put option. Okay, that's what I have explained, and it gives amazing results on Wednesday and Thursday. This is very important point that everyone to remember this point. Okay, name of the strategy is short triangle option strategy, and this strategy gives amazing results on Wednesday and Thursday. Okay, and it gives good results, it gives good results on Monday and Tuesday. It gives amazing results on Wednesday and Thursday because theta decay happens more faster on Wednesday and Thursday when compared to Monday and Tuesday. Okay, so that is the reason short triangle option strategy will give amazing results on Wednesday and Thursday and it gives good results on Monday and Tuesday. Okay, that's a very important point that every option seller or every guy who is watching this session should remember. Okay, short name of the strategy is short triangle option strategy. It gives amazing results on Wednesday and Thursday. That means it is highly suggestible for you all to implement this strategy on Wednesday and Thursday for sure. Okay, and you can also implement it on Monday and Tuesday. It will also give good results. Okay, so now you already know when to implement. Okay, now what should be the entry, exit, stop loss for short triangle? So you told me everything. Now you are thinking like this. You told me everything. What strike to choose, and when to choose, and what should be the wicks, and what should be the theta decay, and what should be on which day should I be trading, or on which day will I get good profit. You already know this. Wednesday and Thursday is best day for short triangle, and Monday and Tuesday can be good days for short triangle. So you already know all these things. Now you need to be knowing when to enter, at what time to enter, and when to exit, at what time to exit, and what should be the stop loss. Okay, these 3 points are very important. When to enter, why to enter. Okay, first thing. Second thing, when to exit and why to exit, at what time to exit. Okay, and third thing, stop loss, which is very, very, very important. You should not be ignoring stop loss. You should not be forgetting stop loss. Okay, stop loss is like uh, okay, it will help you. It will cut down your losses. Okay, instead of losing lot many money, it will help you to lose very less money if you put proper stop loss. Okay, so let's learn about all those things in next few minutes. They're very important. Just concentrate on the session. Okay, all right, this slide is very important. Among all this, among all the slides that I have prepared, this slide is very important relating to this strategy. Okay, entry should be around 10 a.m. strictly. This is very strict. You need to be following each and every point which is written on this slide. Okay, so entry should be around 10 a.m. every day. It can be Monday or Tuesday or Wednesday or Thursday. Okay, entry should be around 10 a.m. only. When I say around 10 a.m., it can be from 9:55 to 10:05 or 10:10. Okay, so entry should be around 10 a.m. And before making an entry, consider OI and change in OI and wicks. That's what I told. You need to be looking at OI that should be having highest value. Okay, I mean the out of the money strike which you are choosing towards call side and put side, that should have highest value, right? So you need to be looking for that thing, and you should be also looking for change in OI thing. Okay, and third thing is you need to be looking at India wicks that should be less than 24 or 25. Okay, that means market will, that indicates that market is calm and market gonna make time pass. And if VIX is less than 23 or 24, there is a high probability of market moving sideways, and that benefits short triangle option strategy. Okay, so VIX should be less than 23 or 24. Okay, and we need sideway market to achieve good results using this strategy. That's what I told. Sideway market directly implies time pass market, directly implies theta decay, directly implies to bringing premiums down. Okay, now we can implement short triangle on Monday, Tuesday, Wednesday, and Thursday. Okay, do not implement this strategy on Friday. Point to remember, do not implement short triangle strategy on Friday. You can implement this strategy on Monday, Tuesday, Wednesday, and Thursday. Okay, works best on Thursday, which is an expiry day. I repeat, this slide is very important. I'm going to explain each and everything again, which is present in this slide. Okay, so entry should be around 10 a.m. When you're dealing with this strategy, you need to be selecting strike price, out of the money call strike and out of the money put strike at around 10 a.m. Okay, when I say around 10 a.m., that should be between 9:50, 9:55 to 10:05, 10:10. Okay, so the average time should be around 10 a.m. You need to be selecting strikes at 10 a.m. and you should be implementing this strategy around 10 a.m. Okay, and before making an entry, you need to be considering OI and change in OI. OI is open interest, and you need to look for highest value in the OI column towards call side and put side, and you need to be selecting or shorting out of the money call side and out of the money put, which is having highest OI. Okay, so when you will short, you should be shorting by looking at the VIX. VIX should be less than 23, 24, or 25. Okay, when VIX is less, market moves sideways. If market is moving sideways, that means it is doing time pass. That means when it does time pass, premiums will decrease, and that benefits this strategy, short triangle strategy. Okay, so we need sideway market to achieve good results using this strategy. Remember this point, and we can implement short triangle on Monday, Tuesday, Wednesday, and Thursday. I already told you in previous slide. It gives amazing results on Wednesday and Thursday, and it gives good results on Monday and Tuesday. Okay, so you can implement this strategy on Monday, Tuesday, Wednesday, and Thursday, and it gives amazing results on Wednesday and Thursday, and it gives decent or good results on Tuesday, on Monday and Tuesday. Okay, and it works based on Thursday because it's an expiry day, and this strategy gives amazing results on Wednesday and Thursday. Okay, Thursday is best. So if it is Monday and Tuesday, trade on Nifty index. Okay, that's just an advice, or that just a suggestion. Okay, if it is Monday and Tuesday, trade on Nifty index, because Nifty index is less volatile compared to Bank Nifty index, and it's safe to practice on Nifty index first. Okay, so if it is Monday and Tuesday, trade on Nifty index. If you're doing it for the first time, you need to be practicing everything on Nifty index only, because Nifty index is less volatile when compared to Bank Nifty index. Okay, and Nifty index is safe to practice. Okay, it's safe to practice on Nifty index first before implementing strategies on Bank Nifty. Bank Nifty is highly volatile, and Bank Nifty is highly volatile, and it makes wild moves. Okay, so it's better to practice first on Nifty index, then come on to Bank Nifty. Okay, so if it is Monday and Tuesday, trade on Nifty. Even if it is Wednesday and Thursday, also trade on Nifty index first, gain confidence, make money, then come on to Bank Nifty index. Okay, so if it is Wednesday and Thursday, trade on Bank Nifty index for better premiums. Okay, you will get good premiums on Wednesday and Thursday if you trade on Bank Nifty index. Okay, that's a suggestion. And exit. Okay, now you told me when to enter, why to enter. Now tell me when to exit. Okay, that's what your question, right? Understand. So exit should be at 1 p.m. or 1:15 p.m. These are strong rules. These are strict rules. Okay, you need to be following this. If you violate, you lose money. We are speaking with experience. Okay, we are doing this since long time. We have experienced it. We have studied market closely. Okay, so we wrote all the slides. We prepared all the slide with experience. Okay, so you should not be. You can go against our experience, and you can go against our advice. Okay, but you will face losses. You may face losses because we had that. That is the reason I am telling. I'm speaking, and I have prepared the slides with experience. So with that experience, I'm telling that you should be exiting at 1 p.m. or 1:15 p.m. when you are dealing with this strategy. Okay, entry should be at 10 a.m. around 10 a.m. and exit should be at 1 p.m. or 1:15 p.m. Okay, so market will be more volatile after 1 p.m. or 1:15 p.m. Why? Because European markets open after 1:15. Okay, so that is the reason market will be more volatile after 1 or 1:15 p.m. And because of that volatility, uh, your profits make I mean all your profits will become zero, or they get on to negative because of that volatility. Okay, so these rules are strict. If you follow, it's good for you. You will make good money and consistent money. Okay, so entry should be around 10 a.m. and exit should be around 1 p.m. or 1:15 p.m. because market will be more volatile after 1 p.m. or 1:15 p.m. because European markets open after 1:15 p.m. Okay, so for short triangle, we need less volatile market. That's what I told. We need less volatile market, sideway market, and VIX should be less than 24 or 25. Okay, so for that, after 1:15, European markets open and VIX may increase. Volatile, market may become volatile, and that may affect our strategy. So that is the reason you should be entering it 10 a.m. and you should be exiting at 1 p.m. or 1:15 p.m. before European markets gets open. You should be exiting your trades if you are using this strategy. Okay, so it's ideal to exit when it's 1 p.m. or 1:15 p.m. Okay, or exit when you see 500 rupees profit, around 500 rupees profit when you are trading with one lot. Okay, or exit when you see around 1000 rupees profit when you are trading with two lots. Okay, so in terms of profit, if you want to exit, you should be exiting immediately if you see 500 rupees profit, around 500 rupees profit when you are dealing with one lot, when you are trading with one lot. Okay, if you are trading with two lots, or if you're practicing with two lots, you should be exiting immediately if you see 1000 rupees or around 1000 rupees. Okay, when you are trading with two lots, or you should be exiting at 1 p.m. or 1:15 p.m. irrespective of profit or loss. Okay, now stop loss. Stop loss varies from day to day when you are dealing with short triangle. Okay, so what I told, I asked you guys to work on Nifty on Monday and Tuesday, and you guys need to be practicing on on Bank Nifty on Wednesday and Thursday. Okay, so Nifty Monday stop loss, premium of CE plus premium of PE minus 15. Okay, stop loss should be premium of CE plus premium of PE minus 15 for both CE and PE. Okay, I know you, most of the guys are confused. Let's get okay, what are the strikes that we have selected? 14,200. Okay, this is Bank Nifty. 31,000 PE, 31,500 CE. Let me add them. 31,000 PE, 31,000 PE, 31,500 CE. Okay, so now see, what should be the stop loss? Stop loss should be 318 plus 280. Okay, see, these are the premiums, 318 and 280. These two are premiums. Stop loss should be 318 plus 280. Stop loss should be addition of both the premiums, 318 plus 280, which is 598. So 598 should be stop loss for both call side and put side. Okay, so that's how you should be calculating stop loss. Okay, so what I'm doing, if I'm working on Nifty and if it is Monday, stop loss should be premium of CE plus premium of CE, sorry, premium of CE plus premium of PE minus 15. You need to be subtracting 15 from that addition, and you need to be putting stop loss for both CE and PE side. Okay, if it is Tuesday, you need to be adding premium of CE and premium of, I mean, you need to be adding premium of call and premium of put. Then you need to be subtracting 12. Then that value should be put as stop loss for both CE side and PE side. Okay, if it is Wednesday, if you are working on Bank Nifty, then stop loss should be premium of CE and premium of PE minus 25, and you need to set that stop loss for both call side and put side. Okay, and if it is Thursday and if you're working on Bank Nifty, stop loss should be premium of call and plus premium of put minus 15, and that value should set as stop loss for both call side and put side. Okay, these are strict rules of stop loss. If you follow, it's good for you. You'll, I mean, you won't lose much money. Okay, if you ignore the stop loss, you will be your account will get wiped off. Okay, because when we are an option seller, the risk is unlimited. Okay, your account will your account will be blown off. Your account will be wiped off. You'll end with zero money if you don't put stop loss. Okay, so when you're an option seller, it's always suggestible to put stop loss, and stop loss is very easy. You just need to add premiums of both call side and put side and set that value as stop loss for both call side and put side. Okay, that's it. So for Monday, you need to be subtracting 15. For Tuesday, you need to be subtracting 12. For Wednesday, you need to be subtracting 25. And for Thursday, you need to be subtracting 15 from that addition of call premium and put premium. Okay, and you need to be put that value as stop loss for both call side and put side. Okay, so here are some important points about stop loss. If stop loss hits on CA side, then PA side gives you huge profits and it protects us from huge loss. Okay, that's what I told when I was explaining about boundaries, break-even points. Okay, so if stop loss hits on CA side, then PE side gives huge profits because positions are hedged. The strategy is hedged strategy. Okay. If stop loss hits on CA side, then PA side will give you huge profits. Then it protects us from huge loss. Okay. And if stop loss hits on one side, loss will be very less. That's what I told, because you will be getting profits from the other instrument. If stop loss is gonna hit at CA side, you'll get money from PA side. If stop loss is hitting at PA side, then you will get money from CA side. Okay, because positions are hedged here. Okay, so if stop loss hits on one side, loss will be very less, and if stop loss hits on one side, exit from both the positions. It's suggestible to exit. It's suggestible to exit from both the position if stop loss hits one side. For example, this is a range, right? The range is 14,600 and 14,200. This is a range. If market comes like this and hit your stop loss, you should be exiting from PE side and PE side, CE side. So if stop loss hits on one side, you should be exiting from both positions. Okay. If stop loss hits on CE side, you should exit PE trade and also CE trade. Okay. So it's suggestible to exit from both the trades if stop loss hits on one side. Okay. And so if stop loss hits on one side, we can exit from both the positions. Okay. So we can exit from both the positions and we have a chance to make adjustments and make profit. Okay. So I'll be talking about adjustments, what to do, how to make adjustments and all those things in later sessions. Okay. That's an advanced concept. So I'll be talking about adjustments in upcoming sessions, not now. Okay. And adjustments play key role in option selling. So even if your stop loss hit, even if you're facing losses, with proper adjustments you can bring back all your lost money. Okay, so adjustments is nothing but you make adjustments to minimize your risk and to bring that back into profits, to bring back that lost trade into profits. Okay, and adjustments keep our positions hedged. Okay, hedging is nothing but, I mean, irrespective of market movement, I mean, hedging is a process which can be used to minimize the loss. Okay, the proper definition of hedging is nothing but it's a process or it's a theory which can be used or which can be applied to reduce the loss. Okay, that's the reality, or that's the meaning behind hedging position. Okay, that's all about stop loss and adjustments. And as I told, you should be exiting from both the positions if market is crossing the boundaries, if market is crossing the break even boundary lines. Either it can be upper boundary or either it can be lower boundary. Okay, so yes, let's talk about other important points that you need to be keeping in the mind while dealing with short triangle option strategy. Okay, so yeah, this is very important. I have been talking about what type of strike prices that you need to be selecting. So you need to be considering three main things while choosing the strike price. The first thing is strike price should be definitely out of the money strike price. Okay. I mean, the main aim, the base of short triangle option strategy is we should be selling immediately two things. One is out of the money call option and the second one is out of the money put option. Okay, so there are lot many out of the money call options and lot many out of the money put options. Among those, which strike price to choose? Okay, so you need to be selecting the strike prices which is having high OI and high change in OI. That's the first thing you need to look for while selecting the strike prices of out of the money calls and puts. Okay, and the second thing is, before implementing the strategy, you need to look for India VIX. India VIX should be less than 24 or 25, okay, to implement this strategy. If India VIX is more than 24 or 25, do not implement this strategy. There are other strategies for that. I'll be teaching all those things in upcoming sessions, okay. And third thing is premiums should be close to each other, okay. If you are choosing out of the money put some strike, and if you choose out of the money call strike, those premiums of out of the money call and out of the money put should be close to each other. Not very close, but they should be little close to each other. I mean, maybe 10-point difference or 15-point difference, not more than that. Okay. So, I mean, they should be close to each other. Okay. These are the three things that you need to be considering while selecting strike prices. Okay. This is very important. That is the reason I have put it again. Okay. And what are the things that short triangle strategy needs to make it more effective? Okay, so we need low volatile market. That's what I have been speaking since the beginning of this session. Okay, we need less volatile market, we need sideways market, we need a time pass market to gain more from this strategy. Okay, so that means we need less volatile market. Okay, so that's the first thing that you need to check for before implementing this strategy. And theta will have positive impact on short triangle. Okay, theta is nothing but time decay. Time decay, what if time decay happens? Premiums will come down. We are in short position in out of the money call and out of the money put. So we need premiums to decrease. So theta will help us. That is the reason theta is a best friend of option seller. Okay, we are an option seller here because we are selling out of the money call option and out of the money put option to make it short triangle. Okay, and always have a look at option Greeks and also payoff chart. Payoff chart is very important. You need to, that helps you to understand loss that you may face if it goes against your direction, or it tells you how much profit you're gonna get if market is staying at some point, and it tells you the break-even points. Okay, break-even points are very important. You should be marking break-even points on your chart, and you should be looking if it is crossing, if it is breaking the boundaries and coming out of that break-even points, then you need to make adjustments or exit from both the trades. Okay, so as a beginner, you should be exiting it. You should be exiting from both the positions. If stop loss hits on call side, you should exit from call side and put side. If stop loss hits on put side, then you should exit from put side and call side as well. Okay, you should be exiting from both the trades if stop loss is hitting one side. Okay, and always prefer to short OTM calls and OTM puts. That's the main base of the strategy. Okay, we should be choosing only out of the money calls and out of the money puts. Okay, and theta is more powerful on Thursday. We already know that theta is time decay and it's more powerful, more effective, and theta will be more energetic and enthusiastic on Wednesdays and Thursdays. Okay, that is the reason this strategy works best on Wednesday and Thursday, and it also gives good results on Monday and Tuesday as well. Okay, do not implement this strategy on Friday. Okay, that's the advice. Okay, and we should be watching stock or index chart instead of watching it options strike price chart. Okay, you already know this. I have been putting this slide in each and every session because there are a lot many students who look for option chart instead of looking for underlying asset chart. Okay, if you are trading with I mean, if you are going long or short on some strike price, you should not be looking at chart of that chart of that option strike price chart. Okay, you should be looking at the main index chart. Okay, so that's very important. And short triangle needs sideways market. That's what I told. And as most of the time market moves sideways, short triangle is one of the best strategies. Okay, and market generally moves in sideways from 10 a.m. to 1 p.m. and so we need to take advantage of that. Okay, so it generally moves in sideways from 10 a.m. to 1 p.m. so we need to take advantage of that. That is the reason I have told you guys to enter at 10 a.m. and exit at 1 p.m. Okay, after 1:15 European markets will open and it will become more volatile, and that may eat all your profits. That is the reason your entry should be around 10 a.m. and your exit should be around 1 or 1:15 p.m., not more than that. Okay, irrespective of your profit and loss report. Okay, and if it's close to expiry, theta will end all your profits when we are in short strangle position. Okay, uh, because theta is more powerful during expiries. All right, so here are some tips. Always select strikes which are having high OI and high change in OI with less wicks. Okay, so always select the strikes which are having high OI and high change in OI with less wicks. Okay, and so if it's Monday and if it is Tuesday, it is suggestible to select Nifty strikes. And if it's Monday, select Nifty strikes whose premiums are close to 40 for CE and PE. And if it is Tuesday, then you need to be again trading on Nifty only because it's less volatile and it's suitable for beginners. So if it is Monday, choose strikes whose premiums are close to 40. And if it is Tuesday, choose strikes whose premiums are close to 35. Okay, these are pro tips. Okay, if you follow, uh, it will give you an edge. Okay, in the live market because we have been doing it since many years. That is the reason I have put this slide. Okay, so if it is Monday and if it is Tuesday, you need to be working on Nifty strikes only, and you should be choosing the premiums which are close to 40 if it is Monday, and if it is Tuesday, you need to be choosing the strikes whose premiums are close to 35 for both CE and PE. Okay, and if it is Wednesday, select Bank Nifty and choose the strikes whose premiums are close to 80 for both CE and PE. And if it is Thursday, you need to be choosing the strikes whose premiums are close to 35 for both CE and PE. And don't forget that entry should be around 10 a.m. and exit should be around 1 p.m. Okay. Do not forget to put stop loss. And the last thing is, if it is Thursday, you need to be choosing the premiums you need to be choosing the strikes whose premiums are close to 20 for both CE and PE and short them before 9:20 a.m. on Thursday morning. Okay, this last point is very important. Try out with proper stop loss. It will work. Okay. If it is Thursday, select Bank Nifty strikes whose premiums are close to 20 for both CE and PE and short them before 9:20 a.m. because after 9:20 a.m. decay happens more faster and you will lose that premium. Okay. So you need to be very accurate. We need to be hyperactive, shorting them before 9:20 a.m. to grab the premiums. Okay. You need to be shorting the premiums. You need to be choosing the strikes whose premiums are around 20 for both CE and PE and short them before 9:20 a.m. Okay, because after 9:20 a.m. theta decay happens more faster and premiums will erode. Okay, so I'm expecting that you guys are pretty clear with this strategy, and I'm hoping that you guys are happy with the strategy. Okay, so if you have any questions, call me up at any time or you can message us anytime. So if you guys like this strategy and if you are impressed with the teaching, please like this video and subscribe to YouTube channel. Thank you guys. Thanks a lot. Thank you everyone.